Most people in the USA, UK, and Canada don't struggle with money because they earn too little. They struggle because they don't understand how credit really works. Your credit score quietly controls some of the biggest decisions in your life, whether you get approved or rejected, how much interest you pay, and how expensive or easy your financial future becomes. But the problem is that no one explains credit in simple words. Banks don't teach it, schools ignore it, and many online videos only confuse beginners. In this complete guide, I'm going to explain credit scores and credit cards from absolute zero using clear language, real-world logic, and practical examples used every day in countries like the USA, UK, and Canada. You'll learn what a credit score actually is, how credit cards affect it, the mistakes that silently destroy credit, and how normal people, without being rich, build strong credit step by step. Whether you're a beginner, a student, a new immigrant, or someone trying to fix past mistakes, this video will give you clarity, because small changes in how you use credit can save you thousands of dollars over time. Now let's start with the most important question. What exactly is a credit score? A credit score is not money, it's not your income, and it's not a measure of how rich you are. It is simply a trust score that tells banks and lenders how reliable you are when it comes to borrowing and paying back money. Banks don't know you personally, so instead of trusting emotions, they rely on data, and your credit score is built from your past financial behavior over time. When you borrow money and pay it back on time, your score slowly increases, and when you miss payments, use credit carelessly, or ignore bills, your score drops. In the United States, credit scores usually range from 300 to 850, where higher numbers mean lower risk and better financial opportunities. And while the numbers look different in the UK and Canada, the logic is exactly the same everywhere. A good credit score helps you get approved for credit cards, loans, car financing, rentals, and even cheaper phone plans, while a bad or missing credit history makes life more expensive through higher interest rates and rejections. Many beginners believe that avoiding credit completely is the safest option, but in reality, having no credit history is almost as bad as having poor credit, because banks have no data to trust you. Credit scores are built slowly, month by month, through consistency and discipline, and they reward people who use credit responsibly over long periods of time, not people who look rich or earn a high salary. A credit card is not free money. It is a short-term loan that resets every month, and how you use it sends strong signals to banks about your financial behavior. Every credit card comes with a limit, and the percentage of that limit you use, called credit utilization, plays a major role in your credit score. Because using too much of your available credit makes lenders see you as financially stressed even if you pay on time. Staying below 30% of your limit is considered healthy, while keeping usage under 10% is ideal for building strong credit. Payment history is the most important factor of all, and paying even one bill late can damage your score for a long time, while consistent on-time payments steadily increase trust. Paying only the minimum amount keeps your account active, but increases interest and slows progress, whereas paying the full balance each month avoids interest and builds credit faster. Credit cards reward discipline and punish carelessness, so people who treat them like debit cards, spending only what they already have, build strong credit over time, while those who max out cards apply for too many at once, or miss due dates often damage their score without realizing it. Your credit score is calculated using 5 main factors, and understanding these gives you control instead of confusion. The biggest factor is payment history, which means paying every bill on time, because even one late payment can seriously damage your score and stay on your record for years. The second factor is credit utilization, which looks at how much of your available credit you are using, and keeping this low, ideally under 30%, shows lenders that you are not desperate for money. The third factor is credit history length, which rewards people who use credit responsibly over long periods because older accounts make you look more stable and trustworthy. The fourth factor is credit mix, which simply means having different types of credit, such as credit cards and loans, showing that you can handle more than one responsibility. The final factor is new credit inquiries, and applying for too many cards or loans in a short time can temporarily lower your score because it signals risk. When all these factors work together consistently over time, your credit score grows naturally, not because of tricks, but because of predictable, responsible behavior. Most people damage their credit not because they are irresponsible, but because they don't understand the rules. And beginners often repeat the same costly mistakes. One of the biggest mistakes is missing a payment even once, because late payments hurt your score more than almost anything else and stay on your record for a long time. Another common mistake is maxing out credit cards or using a large percentage of the limit, which makes lenders think you are under financial pressure even if you plan to pay it back. Many people also apply for too many credit cards in a short period, not realizing that each application creates a hard inquiry that temporarily lowers their score. Closing old credit cards too early is another hidden mistake because it shortens your credit history and can increase your utilization ratio overnight. Some beginners also avoid credit completely, thinking they are being safe, but without using credit at all, there is no history to build trust. These small but repeated mistakes silently destroy credit scores and make borrowing more expensive than it needs to be. Building a strong credit score is not about earning more money. It's about creating simple habits and repeating them consistently over time. The first step is to open one basic credit card and use it lightly, only for small, planned expenses that you already have cash for. Keeping your credit utilization low, ideally under 30%, and even better under 10%, signals control and stability to lenders. Paying every bill on time, without exception, is the most powerful action you can take. And setting up automatic payments helps prevent costly mistakes. Avoid applying for multiple cards at once, because slow and steady growth looks safer than rapid expansion. Keep your oldest accounts open to build a longer credit history, and check your statements regularly to catch errors early. Over months and years, these simple actions compound into strong credit, better financial options, and lower interest rates, proving that credit success comes from patience and discipline, not shortcuts. For beginners, the best credit card is not the one with the biggest limit or the most rewards, but the one that helps build trust safely. Starter cards, secured credit cards, or basic no-fee credit cards are designed for people with little or no credit history and are easier to manage. These cards usually come with lower limits, which actually helps control spending and keeps credit utilization low. Avoid cards with high annual fees or complicated reward systems in the beginning, because the goal is not perks, but consistency. Using one simple card responsibly, making small purchases, paying the full balance on time, and keeping the account active does more for your credit score than juggling multiple cards. As your credit improves, better offers naturally follow. But strong credit is built by mastering the basics first, not by chasing rewards too early. Credit is a long-term system, and one of the biggest mistakes people make is expecting fast reported results. Small positive actions, like on-time payments and low credit usage, can start improving your score within a few months. But strong and stable credit usually takes years, not weeks. Fixing bad credit also requires patience, because negative marks such as late payments or collections stay on your record for a long time, even after you correct the behavior. The good news is that consistent responsible use slowly outweighs past mistakes, and lenders care more about recent behavior than old errors. There are no instant fixes or legal shortcuts that permanently boost your score overnight, but people who stay disciplined often see meaningful improvements within 6 to 12 months and long-term stability within 2 to 3 years, proving that credit rewards patience more than speed. There are many myths about credit that confuse people and quietly hold them back, and believing these myths can be just as harmful as making mistakes. One common myth is that checking your own credit score hurts it, when in reality, personal checks do not affect your score at all. Another myth is that carrying a balance every month helps build credit, but this only increases interest payments and does nothing extra for your score compared to paying in full. Some people believe closing unused cards improves credit, when it can actually lower your score by reducing available credit and shortening your history. There is also a belief that high income guarantees good credit, but income has nothing to do with your credit score. Behavior does. Understanding what is true and what is false helps you make smarter decisions and avoid unnecessary damage to your financial reputation.